Hey, Movie Trades! I want to do a video analysis update on my favorite dividend ETFs that I think really take the fun, out of investing. The, commonly cited statistic is that, people who try to make a living off the stock market and, stuff like that, trying to be professional traders and professional investors, they quit after 2 years, right? They quit after 2 years and 95% of them are done, and I think that a big part of that is, and I think the financial media is partly to blame. I think that, the blessing of commission free, options trading, commission free, trading on growth stocks is, to blame too. But I think the biggest thing is that people come to the stock market and they're looking for fun, right? They're looking for fun. And some say everyone gets, if you're looking for fun, you're going to get it, right? But you can't, really get money out of the market if you're looking for fun, right? And so that's, not my opinion. I'm not a certified financial advisor, but, I do, invest in the stock market, and, everyone's a dumb money retail trader and a professional trader the moment they open up that brokerage account. So I guess I'm both. But anyway, I'm going to go over my favorite dividend ETFs. Really the ones that I think are going to take the fun out of the market. I'll get to what that means. But really, they're going to get pretty damn close to the same returns annually on average, right? So all end dates for the returns are returns since performance analysis ends on 9/12/23, and all the returns quoted are annualized returns. So I believe, the ETFs, at least for me, are going to outperform the market in terms of risk, right? If they don't have the same return or more as the market, they're going to have, slightly less, but they're gonna get it with much less risk, right? So that's kind of the risk-adjusted return, right? These ETFs are going to take the fun out of the market. So, I wanted to get, a little thematic, a little artsy. There's a show called Rick and Morty, right? And Rick is the smartest man in the universe, right? He even invents a portal gun so he can go to these different dimensions, right? And there's an episode, season 1, episode 9 of Rick and Morty, where, Rick and Morty, the show, they kind of always go through these common sci-fi tropes and they turn them on their head, right? So this episode, they go through the common sci-fi trope of, making a deal with the devil, right? You make a deal with the devil and there's a catch, right? You're going to get all this fame and fortune, but we have all types of stories of what, the people who get fame and fortune and, end up on the big screen and in Hollywood, have to go through, right? There's a catch to that life, right? You make a deal with the devil, right? So this, episode of Rick and Morty, he goes to a shop run by this guy who's kind of an old school devil figure. He makes these items that he gives to people, and he says no one pays with money, right? You don't pay with money with the devil because there's a catch, right? One of these is aftershave that makes a guy named Mr. Goldenfold, who isn't very attractive, and makes him attract beautiful women. But the catch is that he's now impotent, right? So he's got the beautiful women, but he can't do what he'd like to do with them because he's impotent now, right? There was this classic monkey's paw catch-22 catch, right? The Nicolas Cage films and Ghost Rider, right? All those films are about this exact same type of thing, right? There's no free lunch is what we say in economics, right? There's no free lunch. And so there's kind of this dualistic principle the devil always represents. You don't get night without day. And so what Rick does is he's the smartest man in the world. He's the smartest man in the world. So he goes and he gets in his garage and he figures out a way to remove all of the catches, or I should say curses, from Mr. Needful's items. So that now there's only a blessing, right? So he goes and he makes Mr. Goldenfold's aftershave only make him attract beautiful women. It no longer makes him impotent. And he's able to do that with every item in his store, so that he even opens up a store across the street that just sells the cure to these curses and gives them away for free. So now the devil is a big hit, right? This old school devil is a big hit, because you can just go to his store and get a bunch of items that have curses, have big blessings, but they also have curses, and then Rick will remove the curse for free. He's a big hit, right? And so the end of the episode, Mr. Needful says, I may be the devil, right? But your dad's the devil. He's the real devil, right? So I've been getting a little bit of a religious theme, to my channel recently. So what does this have to do with these ETFs, puppy trades? Well, in classic literature, in film, if you make a deal with the devil, there's a catch, right? The catch 22. The devil represents a principle and law of reality that says we can't have day without night. We can't have life without death. We can't know something smells like roses unless we smell something that smells like stank, right? So Christians believe, right, that at the end times, Satan is going to come out of hell and he's going to rule earth. And a lot of people who study, religion and also other esoteric things believe that what Christians are actually referring to when they talk about the end times is the end of the age of Pisces. So 2023 years ago is when Jesus Christ, right, who all the Christians, they have the Jesus fish, right, because Jesus is Pisces, all the stories about Jesus and the fish, he turns, 5 fish and 3 loaves of bread or vice versa into an infinite number, right? They're all about fish, right? What's going on here? Well, Jesus is Pisces, and the age of Pisces is coming to an end, and that's what people believe, and even the Bible kind of suggests. I can get into more astrotheology, but the astrologers kind of believe that what the Christians are really talking about and is when they say the end times is coming, they're really saying the end of the age of Pisces is coming. We're going to go from this age of belief, right? We're saved by faith in Jesus, to the age of Aquarius. We're going to end the age of Pisces, Jesus, right? The Jesus fish, Ichthus, the 153 fish at the end of the book of John, right? All the miracles with fish, multiplying the fish. We're going to go from the end of the age of Pisces, and this is important to non-Christians. It's just not really, important to anyone but me, I guess. But this is why your taxes are due at the end of the year of our Lord 2023. You're on a calendar based on this. You're paying bills monthly based on this, right? Because the lunar cycle and the years and anyway. The end of the age of Aquarius is what many people in astrology believe is what Christians actually are referring to, the beginning of the age of Aquarius and the end of the age of Pisces are what many people in astrology think Christians are actually referring to when they talk about the end times. And so the devil that comes about, right, and just before I get into that, this period, many people believe, began in late 2020. So in late 2020, December 2020, there was an event called the Great Conjunction, which is the closest that Jupiter and Saturn have gotten. I think it's the closest they've ever gotten. But this astrological event is what people believe is referred to as the war in heaven, right? Satan is Saturn. A lot of people think Jesus is represented by Jupiter. In the Catholic Church is represented by Jupiter for a number of reasons, right? It started by a Jew named Peter, wink, wink. But anyway, there's this war in heaven between Saturn and Jupiter. And that was the Great Conjunction that took place in late 2020. A lot of people in astrology think that was what began the age of Aquarius, what is what the Christians are going to refer to as the Great Tribulation, the end times, right? So Satan, Rick, in Rick and Morty, the real devil, he's represented by a few things, but in the book of Genesis, he's mostly represented by knowledge. He tells Eve to eat from the book of the tree of knowledge. Sorry, to eat from the fruit of the tree of knowledge. Right? To eat from the fruit of the tree of knowledge. We'll get into that later. Right? So a lot of people think all this AI, the explosion of knowledge, the information age, right? But AI now, potentially becoming this explosion of knowledge far surpassing humanity's, right? All coming about after this period. And, all these apocalyptic storms, climate change, they call it. Christians are going to call this the apocalypse, right? And so this explosion of knowledge, it takes away duality, essentially. Now there's a chance to have, life without death, potentially, if we upload our minds to the cloud, or something like that, right? And a lot of Christians think that's demonic. Anyway, circling back around, many Christians believe we are in the end times in a period known as the Great Tribulation, and that Satan is coming down to earth. The time, and I'm getting artsy, okay? This is all fun for me, but it's also how I collect, data, and, this is just kind of my favorite way to do it. YouTube really makes me put my thoughts, together. But the timing of these ETFs in recent years, right? Because all these ETFs, that's another big point. A lot of these ETFs that don't have that classic trade-off, right? Satan duality. We're going to get into ETFs that don't have that classic trade-off, or they mitigate the crap out of it, in my opinion. We're going to get into ETFs that don't have that classic trade-off. They've removed duality. And in recent years is when most of these have come into existence. So this ETF was inspired by QQQY, a brand new ETF that launched on 9/14. That's going to sell a put on the QQQ ETF every trading day. A single day, a 0 DTE day till expiration put on the NASDAQ. So the yield could be huge. A lot of people in finance are thinking an ETF like that, what's that going to do to markets, man? Right? A lot of people think the yield max ETFs, OARK yielding 29%, Tesla, yielding 45, 49%, and that's at the low end of what they've been yielding, all year. Anyway, Clip yielding 50% right now. We're going to talk about, non-religious ideas, but I just wanted to plant that for a little bit. Using the S&P 500 as a benchmark for risk and return. SPYI has a beta of 1. These are the returns for the S&P over the past, various time frames, right? So we got pretty bullish the past 10 years, 20 to 30 years, that range. The 2000s, we were in a drought. The past 50 years, the past 100 years, we're at about 10.5, 10.7. So I've used 10.5, I believe, as the benchmark for returns in this video. SPYI's beta is 1, right? And so SPYI's beta is 1. Anything with a lower beta than that is going to be used as the return for being less risky. So the devilish ETF number 1 that I bought, right? This ETF that's trying to remove the fun, is trying to remove the catch-22, it simplifies Enhanced Income ETF High HIGH. So the past 100-year return for SPYI is 10.5. So for high, the forward yield is 9.56, and the beta is 0.29. So the way that I interpret that is that the yield of high, HIGH, is 9.8% less than SPYI's annual return, right? So the average annual return for SPYI is 10.5. Assuming, big assumption, the forward yield is able to be paid forward, right? And there's a few reasons it might not be able to be. This holds short-term treasury, bond. It holds short-term Treasury yields, T-bills. Right now we have a situation where short-term yields are higher than long-term yields, and so if that situation were to go away, that could potentially adversely affect the short-term yields of the treasuries in this ETF. Would be one way the yields affected. All right, but assuming this 9.56% yield is paid forward and the beta of 0.29 continues, then right now high has a yield that's only 9.8% less than SPYI's annual return, but it does it with 71% less risk, right? So that's supposed to say it does it with 71% less risk. I proofread that. I didn't see that. But anyway, high gets 9.8% less than SPYI's annual return, right? 9.56% versus SPYI's 10.5% annual return, but it's doing it with 71% less risk, and this is what it's holding. It's holding mostly treasury bills. So it's holding mostly short-term treasury bills, about 99.5% treasury bills, and the rest is it's selling credit spreads on TLT. It could also sell credit spreads on SPX. So what their credit spread strategy is that they're essentially selling a closer to money option, and then they're buying to hedge it a cheaper option that's further out of the money with the same expiration date. That's going to produce a net credit, and that's also going to hedge the risk that there's an adverse move. And also what's mostly hedging the risk is that the majority of their portfolio is in very short-term treasury bills not expiring, but their maturities are 12/21/23 and 12/19/23 and 10 October 3rd, 2023. So very short-term, mostly short-term treasury bills. That's why the beta is so low. Selling some credit spreads on TLT, getting a 9.56% return, right? Not very fun doing it with a 0.29 beta. I've been watching this ETF for a long time. It doesn't really move. It's not fun. It's watching paint dry, right? Maybe a March 2020 situation would change that. I'm sure a March 2020 situation would change everything. But this ETF hasn't been fun to watch. The returns, should they keep up, have been fun to watch. Devilish ETF number 2. Now, this ETF is different than any ETF because this ETF isn't just getting, similar returns to SPY with less risk. It's smoking SPY with less risk right now. SVOL, is taking SPY to the woodshed since its inception. Since May 14th, 2021, SVOL has returned 11.17% annually for total returns, and SPYI's total return since 5/14/21 annualized is 5.49% with reinvested dividends. So SVOL, the forward yield is 15.58%, a whopping yield. The beta is 0.58, one of those too good to be true ETFs. And one of the reasons the yield is so low, we'll get into this later, but this is all while the VIX is extremely low. All these yields are why the VIX is very low, and SPY and the Qs have had quite the year. Not a lot of volatility and premium for these ETFs to capture. So the beta for SVOL is 0.58. Total expenses 0.66. So all these ETFs are, I think, relatively cheap. I think this is actually the highest one. SVOL's total return is double that of SPY with 42% less risk through 2 bull periods, because this began May 2021 in mid-May 2021. So it's seen 2 big bull rallies, and it's seen a year-long bear period. A pretty, not a March 2020 situation, but a lot of time, in a lot of different market situations to continue outperforming and beating SPY. SVOL tracks 1/5 to 3/10 of the inverse of the performance of the CBOE Volatility Index, short-term futures index, while seeking to mitigate extreme volatility. So, I looked at this right now. 20%, only 20% of its assets right now are outside of short-term Treasury bills and investment-grade bond ETFs. Okay, so that all the holdings can be seen um, very easily with these ETFs. Devilish ETF number 3. This one, it's the Wisdom Tree Put Right Strategy ETF. It's PUTW. It started to track a different index on 10/24/22. That's the big problem with this ETF. It started tracking a new index 11 months ago. So it's hard to compare performance since it did the first day, October 25th, 2022. Put W's total return 16.58. SPYI's total return 23.24. So SPYI's beat it by 37.5%. The beta suggests it's done so with 37% more risk. Remember, for Put W, that beta is going to be based on the past 5 years of Put W, which is, it's been tracking a different index. So that's kind of the big caveat. It's been tracking a different index for most of its history. It changed the index it's tracking in late October of 2022. Right now, Put W holds 93% T-bills and a 4% floating rate ETF. So it's even, it's all these ETFs, huge theme. Most of the holdings are in short-term Treasury bills or investment-grade bonds. I don't want to generalize. That can change, but that's how the beta is getting so low because they have to hold this collateral. It's a very interesting environment because they can get, and these are all option strategies that institutions have had access to for a very long time. The Put W right now holds 93% T-bills, 4% floating rate ETF. I believe that's a Wisdom Tree floating rate ETF. 0.84% of its holdings sell the October 23 453 put on SPY. 0.27% sells the October 23rd 443 put on SPY. So if I wanted to go sell those options right now, that would be tons of collateral. That'd be 45 grand a piece, of collateral I would need through an ETF though. Getting the opportunity to sell, 2 put options a month. They have a roll date. They now track the Volos U.S. large cap target 2.5% put right index. Complex. Definitely something to look into. I've read the prospectus investment strategy. The put right index tracks the value of a cash secured put option sales strategy. Right. So just think about how much collateral would be needed to do a cash secured put on SPY, let alone 2 per month. It consists of selling put options on the SPDR S&P 500 ETF Trust and a cash collateral account that accrues interest at a theoretical 3-month Treasury bill rate on a daily basis. And what I'd also say about this ETF, while the yield of 10.71 seems high, it seems too good to be true, most of that's been accrued in a period where the VIX has been in the dumpster. For the past 6 months, the VIX has been under 20, and it's been falling ever since this ETF came out. So that's very interesting. Devilish ETF number 4, the NEOS S&P 500 High Income ETF SPYI. Forward yield 11.88%. So the forward yield is beating SPY's annual return on almost every time frame. That's crazy to think about. It's doing it with a lower beta, 0.79. So it's 21% less volatile than SPY. If the yield can be kept up, the yield is higher than SPY's annual return. The total expenses are 0.68. SPYI seeks monthly income with the potential for upside appreciation in rising markets using a call option strategy that may include both sold and purchased SPX options, SPX index options. So that's a big thing. Sorry, not to interrupt. That's a big thing, and that their website gets into a lot for tax purposes. So they're claiming, and they haven't had a tax return year yet to prove it, but they're claiming that they're going to be more tax efficient because of the way the options they're using. Anyway, their website, I'm definitely not a tax professional, says more about that. This may allow for upside participation in rising markets. So the way I interpret their strategy is it's an actively managed fund. If they think based on whatever that SPY is rising, let's say SPY, the SPX is at 4,280. For the sake of my breath, I'm just going to take it to SPY's numbers. Even though they're using the SPX index, let's say SPY was at 428. They'd be selling the 430 call and they'd be getting a big amount of premium. They'd be capping their gains past that premium. So what they do if they think the market's going to rise is they would collect that big premium from the 430 call, and then they would buy the 434 call. And so they would miss out on gains from 430 to 434, but then past 434, they start to participate again. So there's a few names for that strategy, depending on what expiration date is used. As an actively managed fund, they don't have to add a call at all. The returns so far have been pretty impressive. SPYI's total returns since 8/31/22 are 10.82%. Average annualized. SPY's total returns by that same metric, 11.85%. So SPYI's total return annualized is 9.8%, that below that of SPY's, but it's doing so with 32% less risk and a dividend that is 11 times higher. I wanted to have some bonus ETFs. JP Morgan's NASDAQ Equity Premium ETF, JEPQ, JEPQ, yielding 11.1%, very cheap. 0.35% expense ratio, 35% expense ratio. That's the same expense ratio for TLTW. TLTW is the iShares 20 plus year Treasury bond buy right strategy ETF. That's basically running the buy right with a 1% or 2% out of the money covered call on TLT. Same thing for LQDW and HYGW. What I like to do is look for bond ETFs that I think are going to outperform the benchmark TLT, the benchmark LQD, the benchmark HYG, should they exist, and blend them, with about a 40% underlying position. So for HYGW, right, I'm looking for a bond ETF that I think is going to outperform, HYG, and tracking HYG, and let's say I have a 40% allocation to that, and then a 60% allocation is running the covered call on HYG, which I think is going to underperform in the long term. The 40% allocation that I think is going to outperform HYG. Anyway, the idea behind that is the pair trade. I can get more into that in later videos. But anyway, I don't like just being all in TLTW, LQDW, or HYGW. I've got the stats for them right there. What I'm looking to do for these ETFs is blend them, half TLT, half TLTW, half LQD, or an ETF that I think will outperform LQD, like IGLB, and half LQD, half HYG, or an outperformer, and half HYGW. That's getting, that right there would get a significant return from, bonds. In some cases, government bonds. In some cases, investment grade bonds. And so it's all a new landscape. It's all in the past 2 or 3 years. These types of strategies that would have otherwise required a significant amount of collateral have become available, through all these different fund families. And I haven't even talked about yield max in these ETFs. Is it gonna take the fun out of FinSwit, right? Isn't that really all that matters? Is FinSwit gonna be fun anymore? I think there's gonna be parts of FinSwit that will, but as far as getting that big, sexy clickbait, I think these ETFs are gonna take some of the dopamine, out of FinSwit. It's not gonna be fun, to watch markets anymore. It's not fun to watch HIGH and SVOL, in half, LQD, half LQDW. I mean, the bond market's been fun now. But this is all kind of circling back to this idea of duality. Is the catch-22 being removed? Obviously, the risk isn't being removed. But, I've always been told about the free lunch. Are these ETFs, like the devil? They're going to take away, the duality. We're in the end times right now. In Genesis 3:22, the Lord God said, the man has now become like one of us, knowing good and evil. He must not be allowed to reach out his hand and take also from the tree of life and eat and live forever. When duality is destroyed, we have nothing, right? Two becomes zero, and then out of nothing, one shall rise. That's the significance behind, the number 201, the event 201, we had October 10th, 2019, this period that's coming, is going to remove duality. This period all the elites knew about in late 2019, when they had the Bill and Melinda Gates Foundation sponsor Event 201, it comes from this idea. That number 201 comes from this idea, which is what they named Event 201 October 18th, 2019, where they simulated, a zoonotic coronavirus pandemic that later occurred in 2020, this global outbreak they simulated, that they knew was going to happen, was, an homage to this end times that's coming. This event that we had is going to bring about, the book of Revelation. Out of two, we're going to end duality. We're going to have nothing, and then we're going to become one. We're going to have the singularity, right, with, AI, all that. But anyway, are these ETFs and more like them on the way, like QQQY, are they going to destroy the bull-bear duality that plagues retail? For me, they've done an awful lot of help, but what's going to come from FinSwit when we can't call each other bag holders anymore? That's just something I worry about. It's not investment advice. It's just something I've come across researching these ETFs.